Judy Shelton has been on my podcast twice, once with me about 7 months ago, once with Michelle McCory last month. In it, she says, Andy, in no uncertain terms, Trump has told me when I was part of the transition team that he will peg gold to the back end of the bond market on July 4th, 2026. She says this and she sticks to it. It's in her book. And she says he will do that, and that's the 250th anniversary of the country. He will do that to reestablish credibility. So how do you bring back manufacturing? Well, we got the front end of the curve handled. We know everyone keeps talking about devaluing or revaluing gold and devaluing the dollar. James Rickards is saying 24,000 for gold. Mike Maloney says 10,000. Pick your number. The higher the price of gold goes, the more devalued the dollar gets, which helps sell manufacturing to the globe.
In this video, precious metals analyst Andy Schectman shares one of the most explosive claims circulating in the financial world today. According to a discussion he recounts, the U.S. may be preparing for a dramatic monetary shift, one that could fundamentally reshape global finance by July 4th, 2026. Schectman explains that a key insider has stated with certainty that the U.S. could move to peg gold to the back end of the bond market as part of a major credibility reset. The timing is no accident. The nation's 250th anniversary would serve as the symbolic backdrop for a historic realignment of money, value, and national economic strength. If such a peg were established, it would instantly require a massive revaluation of gold, potentially aligning with forecasts of $10,000 to $24,000 per ounce. As he points out, a higher gold price means a significantly devalued dollar, which could ignite a powerful revival in American manufacturing by making U.S. exports dramatically more competitive. A monetary reset, a global shockwave, and a new economic era. This scenario is no longer fringe. Let's get into the interview. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
They have gone from doing everything they can to delegitimize gold and silver to making it far more in-your-face overt. Of course, you know that the U.S. just reclassified silver as a critical mineral, amongst many others. And the amount of gold and silver that have been brought into the COMEX since last November is off the charts. And you know, somewhere in the neighborhood of 200 million, but there are reports that just came out in the Financial Times that said that governments around the world are reporting roughly 1/3 of their official buying, down from about 90% 4 years ago. That's according to the World Gold Council. And then China, which is the world's largest producer and consumer of gold and the second largest of silver, certainly not being transparent how much they own, 10 times they assume more than what they are reporting. And they're also, they just came out and said they're going to limit exports. They're going to tighten silver exports. This is a race, if you will, to accumulate physical metal. And I think the government understands that, not just physical metal, all critical elements. And I think it's no longer about promises from a broke country, in other words, taking our treasuries, and more about who's got the real stuff. You can see this in the amount of deliveries coming off of all of the world's exchanges. You can see this in how the people that are importing hundreds of billions of dollars of metal into the United States are the most, not just the most well-funded traders here in North America, if not the world, they're the most well-informed. But that goes hand in hand with what the central banks have been doing. The first podcast I did with you years ago, that was probably front and center what we talked about, how the central banks have been buying gold. Here you have and silver and other commodities, that you have the most well-informed traders in the world showing you what they are doing. And it's gotten to the point now where there's no reason hiding it any longer. And in particular, if you do want to debase or devalue the dollar, you do it in raising the price of all of the world's commodities, because we've become too accustomed to measuring the currency against a basket of crap currencies, the dollar index. It's not how you should do it. Dollar is down 8 or 9% against the dollar index, mostly the euro, but it's down 70% against silver, 65 or so percent against gold. And so I think it's come to the point where perhaps they do want to debase the currency. Even mainstream media is talking about it now, that it's not a hidden agenda. To me, what they aren't talking about, everyone says it's to pay down the debt. To me, it's bigger than that. It's to be able to have an inkling of a chance to start to sell your manufacturing to the globe. It would be one of the first steps. Now, you could argue that it's premature to do it before you bring your manufacturing back, but I don't know if there is a plan or a strategy on how you do this. It seems to me that the best way to do it would be to let gold and silver move up organically for a while and then maybe revalue it at some point. But I do think that's what they're doing, and they're in your face with it now by taking these positions in companies like this. There's no question about it. I think you'll see more and more of it. It's never really a great deal when you have the government in private enterprise. If the Fed is buying bonds from the banks are the ones that would normally be trading in the repo market. They would have cash. But whether or not they want to lend that cash, for the last several years, the banks have been parking their money in the reserve account at the Fed, earning the federal funds rate, and having no systemic risk. And it's the same thing here. These banks have cash because when the Fed comes calling to buy the bonds from the big banks, the banks sell the bonds, they're obliged to, but they would then in essence have cash. Now, what you do with that cash is another question. And I think to your point, how about we create something called the Genius Act that takes care of that problem, that anytime money moves, it creates a stable coin, which then buys short-term treasuries, because that is a problem we don't want to deal with anymore. Maybe there is something to that question. I am not exactly sure, but I would think that if they were buying the bond, it's the other way around. If they were selling bonds, well, let me just try and figure this out. I'm pretty sure that the act of buying bonds would actually not pull liquidity out of the system unless the banks take that money and park it back at the Fed, which in essence would be deflationary. It would be pulling liquidity out of the system. But if the banks then take that money and make loans, then you are creating money. It's becoming more inflationary. So it's really after that happens that the banks have to decide, what am I doing with the money? And you can see right here, well, hey, I don't really want to lend it. Maybe I'll just give it back to the Fed and leave it in a reserve account making 4% with safety.
In this video, analyst Andy Schectman breaks down the rapid and undeniable shift taking place in global precious metal policy and physical accumulation. What used to be a quiet, behind-the-scenes effort to downplay gold and silver has now exploded into something openly visible, even aggressive. He explains how the U.S. has officially reclassified silver as a critical mineral, a move that signals strategic importance rather than commodity obscurity. At the same time, the amount of metal flowing into COMEX vaults since late last year has surged to extraordinary levels. Reports also show that official government purchases worldwide have dropped sharply, while nations like China, already the largest producer and consumer, are hiding the true size of their stockpiles and tightening export controls. This, Schectman argues, is more than a buying trend. It is a full-scale race to acquire hard assets before the global monetary landscape resets. The shift away from trusting U.S. treasuries and toward holding real, finite materials suggests the world is preparing for currency debasement, possibly intentionally. Measured against commodities instead of weak foreign currencies, the dollar has already lost massive value. The message is clear. The world is positioning for a future where physical resources, not promises, determine power and stability. Let's get into the interview.
You're seeing with a company like Tether, what they're doing with all of this profit that they're earning from issuing treasuries, backing the movement of stablecoins, is they're buying commodities, in particular gold. Over 13 billion, I believe, at last tally, of gold that they're buying, which would debase the dollar. The more gold that you accumulate, the higher the price of gold goes, the lower the value of the dollar goes. It's a way to devalue the dollar. That's what Roosevelt did in 1933 when he confiscated gold at $20 and then devalued the dollar by 40%, making gold $35 an ounce. So in essence, what they've been doing, and I believe what the plan is, and it's part of a bigger plan, and I guess I'll just connect all of the dots and then you can pull any string you want. My belief is this is what they're trying to do on the surface. Look, they want to bring back manufacturing. How do you do that? Triffin's dilemma is the economic theory that says as the world reserve currency, you can't do it because the world needs more dollars than we can provide them through trade alone. And so they, in essence, countries over time have to sell their currency to buy ours. It weakens theirs, strengthens ours. And over time, the continual purchasing of our currency or our exporting of dollars creates an imbalance. where those currencies are so much cheaper than ours in relation that manufacturing naturally flows to the countries where it's less money to produce. The chief investment officer of Morgan Stanley says, sell half your bonds and put 20% of your assets in gold. What did he just say? These are the guys that maybe would have said 5% and probably not even. Sell half of your bonds and buy gold. He said it's no longer the 60-40 platform that Wall Street's used for 50 years. 60% stock, 40% bond. No, make it 60-20-20, 20% stock. Michael Hartnett, the chief analyst at Bank of America, his newsletter is a fortune. Thousands and thousands of dollars a year. It goes to the institutional traders. He says, no, 25, 25, 25, 25. So have 25% stock, 25% bond, 25% short-term treasury, 25% gold. And maybe the craziest of all is the bond king, Jeffrey Gundlach. He says a 25% allocation in gold is not overweight. Now, these three guys, chief investment officer Michael Hartnett and Gundlach, they're not speaking to the plebes. And the plebes are all of us. They're speaking to the institutional traders up at the top. They're speaking to the people who have brought in hundreds of billions of dollars of metal into COMEX since last November. Billions and billions and billions every month. Who the hell is it? Not a word on who it is. No one knows who it is. I have guesses, but who is it? That's who they're speaking to. So to your point.
In this video, the discussion exposes a powerful and overlooked force, quietly reshaping global finance. While most people focus on interest rates and stock charts, the institutions controlling the future of the monetary system are loading up on real assets and doing it at a pace the public has not been told about. One striking example is the explosive growth of Tether's profits and how those profits are being deployed. Instead of recycling gains into traditional markets, the company is aggressively purchasing physical commodities, especially gold. With more than $13 billion reportedly accumulated, the effect is simple but profound. Every ounce purchased pushes gold higher and the dollar lower. Historically, currency devaluation through gold revaluation is nothing new. It's the same playbook used in 1933 when the dollar was slashed by 40%. This trend aligns with a much bigger shift. Major institutional voices, once dismissive of gold, are calling for dramatic allocation changes. Recommendations of 20% to 25% gold weighting from top analysts signal that the wealthiest market players are repositioning ahead of a monetary restructuring. At the same time, enormous unreported gold inflows are hitting COMEX each month, with billions moving under the radar. The message is clear. Big money sees what's coming long before the public does. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in.